I'm here in San Antonio for NAREIT's REITwise, our 2019 Law, Accounting, and Finance Conference. Joining me today is Mark Van Dusen, Principal with Deloitte. Mark, thanks so much for joining us again.
Thank you.
Now here at REITwise, you moderated a panel focused on emerging tax issues for REITs. Can you start by talking about how REITs are dealing with the interest limitation under new section 163J?
I think the good news for a lot of public REITs is that this new interest limitation and the way that it's calculated, at least initially, it's not applying at the public REIT level because they tend to have very low leverage, much lower leverage than is the case for a lot of investors in real estate. But the way this limitation is calculated is going to change in 2022. Currently, the limitation is 30% of what is essentially EBITDA. In 2022, it's going to change to EBIT. And at that point, we're looking at a lot of public REITs that are going to be moved from the situation of not having to worry about this limitation to suddenly in 2022 having to worry about it. And the government has attempted in the proposed regulations under 163J to create some rules that would be helpful for REITs, a certain safe harbor to allow them to qualify for the real property trade or business election, which if that applies, you're completely exempt from the rules. But I'd have to say that the safe harbor that they drafted, it's helpful for some REITs. It's not helpful for the typical public REIT that's operated in an UPREIT structure where they own most of their assets down in an operating partnership. So I think it's yet to be seen whether the government is going to issue rules that once a lot of public REITs start to have to worry about this, is there going to be a safe harbor that's in place that's going to be helpful to them?
And what were the main issues REITs had to face resulting from last year's tax reform legislation?
Yeah, I think the biggest issue that they had to deal with was the 20% deduction that applies for pass-through income. That was intended to apply to REITs. REITs are entitled to rely upon that. But for public REITs, one of the big issues was that nearly 45% of their shares are held by mutual funds and by ETFs. And it wasn't clear that when those REIT shares were held by those mutual funds and ETFs, whether the shareholders in the mutual fund and ETF would also get to benefit from the 20% deduction. And I think that very helpfully the government did issue proposed regulations indicating that 20% deduction does flow out to the shareholders in the mutual fund and the ETF. And so I think that's one of the great things that NAREIT was, in conjunction with other people, were able to get for the industry, because I think there was a lot of concern coming out of the passage of the Tax Cuts and Jobs Act that maybe this 20% deduction wasn't going to be as helpful to REITs as Congress intended.
And lastly, are there any other tax developments on the horizon that REITs and other real estate investors should keep their eye on?
I think it's really the tsunami of regulatory guidance that is going to come out, that is already beginning to come out of Treasury, and it's going to continue to come out of the government as we go into the rest of this year and next year. We'll see final regulations on 163J. We'll hopefully see some more guidance on qualified opportunity zones to make those credits more available for real estate investors. And then there's also always the hope of getting technical corrections for some of the changes to the Tax Cut and Jobs Act that need to be made to make it really work as intended. And so it's almost not a question of what they should be keeping their eye on, it's what shouldn't they be keeping their eye on, because I think there's going to be a lot to come forward in the coming year.
Great. Mark, thank you so much for joining us.
It's my pleasure.
For more information on this and other real estate news and analysis, be sure to visit NAREIT's website, REIT.com.